Coming up on Market to Market. Negotiations with China continue, but the trade war isn't the only battle.
Little by little, so...
And market analysis with Dan Hueber next.
Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, February 22 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. The effects of a trade war with China weigh on rural America. The Creighton University Rural Main Street Index, a survey of bank CEOs, fell just over 3 points, but remained above growth neutral. Banker confidence remains below the midline as tariffs, trade tensions, and low agricultural prices press the index lower. Worldwide stock markets have been reacting positively to trade negotiations as the Dow Jones Industrial Average and China's Hang Seng moved higher. It is against this backdrop we are joined by Tom Vilsack, President and CEO of the U.S. Dairy Export Council, and Kirk Leeds, CEO of the Iowa Soybean Association. Gentlemen, welcome to both of you.
It's good to be here.
It's great to be here.
We have literally breaking news as we are recording this section right now of the show. The announcement or potential rumor announcement of $1.2 trillion in buys coming from China on U.S. all products, not just agricultural products. And I think the word you used, and I'll start with you, Secretary Vilsack, was skepticism.
Well, I think until we know the details, until we know over what period of time, until we know is this in the context of other agreements that the parties have reached, I think at this point in time, I think there's an effort to try to get something on the table so that March 1 comes without the necessity of escalating this trade tension with additional tariffs. I think they have been working extremely hard in a number of areas, but I think there's still a lot of work to do, especially in terms of the structural reforms that the administration is seeking from China. So this may be an effort to try to buy some time. Hopefully that does include agricultural sales for and the farmers, the soybean farmers. Hope it includes some soybean purchases, and obviously I'd like to see some dairy being sold as well.
Kirk, any comments to add to that?
Well, again, I think it's just a very large number, of course, and without any details, we would all be speculating. It was hard enough really to imagine the Chinese buying 30 billion additional commodities, agricultural products, let alone trying to get your mind around $1.2 trillion. That's a significant increase of what they're currently buying. So again, without details, it'd be very dangerous, I think, to speculate. But there is a lot of work that needs to get done. Absolutely true.
This conversation, this trade discussion with China started on the belief that there was an imbalance between the trade relationships between the two countries. And I think the Chinese have interpreted that to mean that if we just buy more U.S. products, that will take care of everything. But the reality is there are a lot of structural issues at play here in terms of how China treats U.S. business interest in China unfairly in a discriminatory way. And the administration, I think, is calling the Chinese out on this. And it's going to be incredibly difficult for the Chinese to acknowledge that they have to change their way of doing business. And that's why these negotiations may drag out, by March 1st and may include a sort of an incremental set of steps towards ultimately, hopefully, a resolution.
Let's talk a little bit about that, the incremental steps, or the March 1st deadline is quickly approaching. Even if we have some sort of quote-unquote deal in place, the next question is what happens after that as far as enforcement or next steps. It doesn't sound like it's going to be a fast process from what you're saying.
Well, I think that there has been some conversation in the media about 6 MOUs, 6 separate agreements, one on agriculture, technology transfer, services, and things of that nature. But I think where the stumbling block is on those MOUs is exactly how will these be enforced. The Chinese can agree to just about anything, but the question is, will they actually follow through? And is there some way of making sure that if they don't follow through, that there's a mechanism for reestablishing the tariffs or some kind of penalty? I think that's what That's where these negotiations are. And then there is the whole set of issues, the very significant structural changes in terms of currency, in terms of the conditions under which American businesses can do business in China that have to be discussed, which are even more difficult to negotiate. So I would imagine that this will be a stepped process. I think they're serious. Ambassador Lighthizer, the Treasury Secretary, are engaged in these conversations, which indicates that it's a very high level.
It almost sounds then as if we're saying it's more of the perception of these trade talks that's more important right now to the commodities and to the producers rather than the reality of what actually happens.
Well, it gives people a sense of hope that actually there will be a resolution that will restore a relationship that has been very beneficial to American agriculture, no question. And I think the administration is also suggesting, at least as far as I can see, that we also need to look at other markets, additional markets, to supplement the Chinese market so that we're not overly dependent on a single market.
Yeah, I think there's been a lot of skepticism from the beginning about what really are the true goals of this administration as it relates to trade, not only in China but around the world. And specifically to China, you had this trade imbalance with the Secretary mentioned, which has been at front of those discussions. But the real issues, the issues that have been going on for much longer, are the issues of intellectual property and tech transfer and the subsidies that the government provides in China. Those are the issues that are difficult. Those issues will not be resolved by March 1st. And the question becomes is whether this 1 trillion or whatever the offer might be, whether that's enough to handle the politics both here in the United States and in China. You know, in the East, Far East and China, they talk about saving face. Is this agreement going to give the Chinese and the Americans something to claim as victory? Certainly publicly, a lot of people think if you just simply buy more products, that solves the problem. But again, that was not the fundamental issue we went into this. And some of us have been skeptical that at the end of the day, this was really more window dressing than it was truly to go after these core issues, which have been issues that went back to the Obama administration, the Clinton administration certainly as well. So that's the real question, I think, about all these negotiations.
And with the negotiations, do we have a real winner? Is someone winning at this point, or is it a war, right? You have a winner and a loser, theoretically. Are we having that with this kind of a trade war?
I think at this point in time, it may very well be that both countries have lost. Seriously, the economies in both the United States and China have suffered as a result. Certainly, I can speak specifically to the dairy industry. We have seen significant drop-off in terms of trade opportunities in China, and whether or not we will be able ever to regain the markets that we had potential advantages in is yet to be seen. So I think there's a pressure, political pressure is growing in both countries to get something done. The March 1 deadline, I think, is critically important because that is the deadline that President Trump has set to determine additional tariffs. And I would say that if additional tariffs were assessed, that there would be a very depressed feeling if that were to occur.
Yeah, I would add, I think the damage has already been done. From a soybean perspective, we have already caused long-term damage to the relationship between China and the United States as it relates to soybeans. We might get some agreement. The Chinese government commits to buying additional soybeans. But remember, we were exporting more than 30 million metric tons to China before all this started. We'll be lucky to sell them 10 million metric tons now, unless, again, there's some government edict that comes forward. So when you lose that kind of market, you have that short-term gain. I've said from the beginning, this is not really a 2018 story. This has always been a 2019 story because that's where the damage from these tariffs and counter tariffs are going to impact soybean farmers. Even USDA yesterday said this is going to take us 8 to 10 years to work through these troubling times. The damage has already been done.
Here's the fundamental problem with this. I think everybody would agree that China needed to be called out on its practices, but the reality is the United States went in alone. And the question is, when was the last time the U.S. went to war without an ally? And why didn't we basically formulate a coalition of nations that are similarly being treated unfairly by China and go in block as a global community to China and say, you've got to change your way of doing business? By going it alone, we put a fairly significant target on the back of American farmers and ranchers, and the Chinese understood that. They understood the politics of it, and they took full advantage of it. And so Kurt's right, it's tremendously prejudicial to the soybean growers because once that market is lost, it is really, really difficult to get it back.
Are you past the point then of creating allies in other global players?
I wouldn't be surprised if this administration gets some kind of interim deal that allows them to save face and allows them to proclaim a bit of a victory. And then for the more structural changes, the long-term changes that really this is all about, I would think they might take a step back and try to formulate that coalition, try to bring the Europeans into it, bring the Japanese, the Koreans, and others into this so that there's a much more significant impact on the Chinese economy than just what we can provide. That's
going to be critically important, but again, I want to be optimistic that that will happen. But again, we still don't have a signed deal with Mexico and Canada. We're going to have European issues that are probably likely coming in because of automobiles. You know, again, it's hard to start getting a coalition after the fact. But these fundamental issues that we talked about are important to Japan, Korea, all of our European partners as well. So you'd like to think that that could happen, and certainly I think it's going to happen. I don't believe we have the ability on our own to force China to make these structural changes. I just don't think it's doable.
I want to come back to talking about the EU, USMCA, and other trade agreements here in just a moment. But Kirk, I want to delve in just a little bit farther to a point you made earlier about soybeans being impacted in the 2018-19 marketing year, this current marketing year that we are in,
right,
as opposed to the previous marketing year. Why do you think we saw MFP payments, or that market facilitation program, happen in the previous marketing year as opposed to this one? And Secretary Perdue said just this week again, we're not going to see one.
Well, I think first of all, we all know it's political, and there was certainly some gains were made politically because of those payments. But I also think the Secretary and the President, I believe, recognized that this was indeed doing real damage to farmers, particularly soybean farmers. You know, I've heard the Secretary, I've been at places where he's given a speech and said they're one time and they're done. We're going to make those payments last year because the damage was done last year, and that farmers will respond to the market, that they have always responded to market signals to change crop rotations. But the challenge that we have here in Iowa is we do corn and soybeans really well. And right now the market is not sending a particularly strong signal that it wants a whole lot more corn. And in fact, if we saw a significant shift here, what would we do with all of the corn? And so, you know, we have depressed prices. I would suggest that the market is still kind of factored in a belief that we're going to have a resolution with China on soybeans. You could easily see this market fall quite a bit if this indeed blows up. So I think the market transition payments are still necessary. I don't think we're going to see them politically, at least unless we have a complete failure on these negotiations.
Gentlemen, thank you both so much. Thank you, Tom Vilsack and Kirk Leeds, for your insight. To catch the full interview with Tom Vilsack and Kirk Leeds, you can head to our YouTube page or markettomarket.org to catch this and more, including trade with Japan, the European Union, and what's going on in South America.
Next, the Market to Market Report.
A week of trade rumors and a confirmed high-level meeting pushed much of the commodity markets higher. For the week, May wheat lost 15 cents and the nearby corn contract rose 2 cents. The May soybean contract finished 2 cents higher after battling back from a weekend low. The move was fed by buzz over letters of an agreement with China and a Friday meeting between President Trump and Chinese Vice Premier Liu He. May meal dropped $1.10 per ton. May cotton grew $1.15 per hundredweight. Over in the dairy parlor, March Class 3 milk futures gained 39 cents. The livestock market was mixed. April cattle put on $1.70. March feeders added 30 cents, and the April lean hog contract shed 408. In the currency markets, the U.S. dollar index fell 5 ticks. March crude oil gained $1.28 per barrel. COMEX gold added $10.70 per ounce, and the Goldman Sachs commodity index gained more than 4 points to finish at 429.80. Joining us now to offer insight on these and other trends is one of our regular market analysts, Dan Hueber. Dan, welcome back.
Thanks very much. Great to be here.
Dan, we spent the first half of the show talking about a lot of the announcements and trade that came out here on Friday, and I've got to ask from a market perspective, this announcement or this rumored announcement that we got here on Friday, the $1.2 trillion in potential buys of U.S. products by China. Does that matter to the commodity markets?
Well, I think it certainly matters. In fact, it's the overwhelming story that really, even before we heard how many dollars may be involved in this, just the idea that they could have a breakthrough on the negotiations, that we could finally be putting this trade war behind us, you know, certainly elevated prices off of what were pretty depressed levels. I mean, when we started this week, there was not much good to talk about. We drove all three commodities, corn, soybeans, and wheat, down to levels we had not seen in months. And you know, not that this is necessarily a major trend changer, but boy, it lifts that cloud that's really been hanging over the market for 10 months now. So,
one higher level question for you before we transition here into wheat. Monday's open? We saw this announcement here right before the close on Friday. Monday, where do the markets head from here? Are they going to react to this 1.2 trillion rumor?
Well, I certainly think it's going to continue to stabilize the market. By the time we get through the weekend, everybody's going to have a little more time to assess it. So unless they come up with some more specifics, which is probably a little bit doubtful because we really haven't even come to an agreement per se yet. But it should help stabilize things a little bit. You know, it gave us a great boost just on overnight on the thoughts that we're coming closer to an arrangement. Didn't really hold great gains per se for the close, but regardless, you know, we're back into the trading range that really we've been in for months here now. So yeah, to go on any above and beyond here, we're going to need something a little more substantial, but regardless, like I say, it takes away some of the overhanging clouds that have been punishing us for months. So.
Definitely, definitely. Let's talk about the wheat markets because they had quite the week. I mean, traded down quite a few cents every day here, closed finally at the end of the week up a couple of cents, but what's going on there? You
know, unfortunately, the wheat market is the one that just can't seem to catch a break when it comes to the export business. You know, just when we were starting to get a little more optimistic that Russia had priced itself out of wheat in the market, we were going to get competitive. France basically stepped up and, or I should say stepped down. I guess they really took their wheat prices down to the point where they were really the most competitive in the world. And even in the Asian markets, here you've got Australia with a tough crop. Looks like they've got another tough crop coming, and we're not really capturing that business into the Far East. They're going to Argentina at this point, picking up their wheat. So, I mean, we have just, every time we think we're right there as far as getting competitive again, somebody else steps in and takes that business. And even the Egyptian tenders this week, we were not competitive. The U.S. stepped away from them, and they went to other markets out there. So,
Dan, how much lower are we going to have to see wheat prices head before we are competitive again on the market?
I guess I would tend to say with the breakdown we did witness this week, we probably took ourselves to low enough levels, you know, not that we couldn't, you know, flirt around these levels for another week or so. But I think by the time we get to March, you know, we'll start to refocus a little bit on growing conditions, what's going to be ahead, acreage, those type of things, take their minds off of, you know, where we haven't been competitive. So I think we have 95% of the worst of it out of the way. So things should look a little better as we move into spring.
Okay. What's the story here when we look at the corn markets? We had the USDA data dump here at the end of the week. Let's talk about ending stocks in particular. We were down from what they pegged us at earlier this year.
Sure.
But they only increased exports, I think, 25 million bushels. Where are we losing, I guess, those bushels from? Well,
again, back with the exports were bumped up 25 million over this year, but of course I think they came back and, you know, if you go back to the February supply-demand report, surprisingly they dropped domestic usage. And I think everybody was scratching their heads a little bit, you know, where is that really coming from? Hog numbers are certainly not down. Cattle numbers, you know, maybe we're slowing the growth in the cattle inventory, but we're still 1% higher, even on the on-feed numbers here today, or 2% higher, I think, on the on-feed numbers today. So I think everybody was a little bit questioning why did they drop that domestic usage? If they were going to make a cut, maybe it should have been an ethanol, and they took it more out of domestic feed. So I think that's been compensated again as they look out in the next year. And realistically, yes, at 1.65 billion projection for ending stocks a year from now is still very ample, but it is a reduction from where we are this year. And so, you know, the old adage is if you're taking ending stocks down, you should take prices steady to higher. So it's not really I mean, granted, we have a lot of weather. We don't really know what the acreage is going to be yet, but, you know, the outlook on corn is certainly not a negative one at this point in time. So,
is it enough of a, I guess, non-negative sign in the corn markets to continue to break us up higher? We hit those lower lows this week, 370 mark. Held there, or do we continue going higher?
I think the upside's still pretty limited. You know, we're really, I think there's going to have to be a combination of two factors moving forward. Once we get beyond, let's say, the end of March, when we get the acreage numbers out there, one is we're going to need to have a weather issue, and I think probably even beyond that, I think even with a weather issue, unless we see the dollar turn lower, and I think the probability is decent that it will, but until we see that dollar turn lower, we really are not going to get the commodity markets, or at least the ag commodity markets excited. So
let's talk about the acreage outlook here for 2019. We've got a question here. Dustin in Granger, Iowa said, assuming USDA's outlook on planting intentions are correct and assuming trendline yields in corn and beans, what does our carryout look like for the end of the next marketing year?
Sure. Well, and here again in corn, that is where they actually came back with a reduction. So it, they took us about 5% lower than we are projected to end out this year. So again, even with the larger acreage, I think they pegged a 176 trend line yield. Trade was thinking it could have been a little bit higher than that. But starting with that base in there, like I say, that really keeps a floor under the corn market. Now, is it enough when you look at new crop corn? It seems like every time we get around $4 a bushel, it tends to run out of steam. Yes, I think that's still the case. It's not enough to really accelerate us into significantly higher prices, particularly considering the increase in acreage. But on the same token, if we're coming up with lower ending stocks, that's certainly not a negative situation.
What's the story then for the soybean ending stocks?
Soybean ending stocks, interestingly enough, they with the slightly reduced yield as compared to what many were thinking. I think a lot of people thought we were going to come up closer to 51 bushels. They were down around 49 and a half with the reduced acres. It's a two-edged sword. Yes, it's a lower ending stocks, but I think we were
845 million, though?
Yes,
Is that enough to make a difference?
It's well, psychologically it helps.
Okay.
It's not enough to sustain a rally by any stretch of the imagination. And any way you slice it, 845 million bushel beans is a lot of beans. So it's like I say, something else is going to have to come into the picture to make that change. And even with China coming back in and purchasing, boy, we're behind the 8 ball for 2019. We maybe can look out to 2020 for some improvements for that.
So is that really what we have to wait for? Something big like that to get us out of this higher, get us through the higher end of the trading range?
Well, yes, and granted, we're far enough along in the South American harvest at this point that, there's a question mark: is it going to be 112 million bushels? Is it going to be, or million metric tons? 115? Anyway, you look at it, it's either going to be the biggest or the second largest soybean crop still out of Brazil. So, even that's not going to be a major mover. Question then becomes what happens a year from now in South America, because the new president in that country has certainly been a strong proponent of increasing acreage. They have definitely said the door is open for investment, and China and other nations have been down there. And this time, not so much investing in the production, but they're investing in infrastructure, new rail, new port facilities. I mean, they are going to be a force to be reckoned with for many years to come.
Yes, that they are. Dan, we're going to save cotton for Market Plus. Folks, you can get Market Plus online on podcasts and whatnot. Dan, let's talk about the live cattle markets. Sure. We pulled back here, posted a new high in the April live cattle markets, pulled back on Thursday. Why?
Well, one, I think it just dollars and cents. When you start looking at the competitive nature of pork versus beef at this point in time, we're really stretching that rubber band out a little bit too far. I mean, if you're really going to go to the retail counter, I mean, granted, there's going to be a certain amount of beef you always want to, or people are going to want to consume, but boy, pork is going to be extremely competitive against it, and I think we just stretched that out too far. So yesterday, particularly, we saw that snap back pretty dramatically. The cattle on feed reports today, would tend to be neutral, maybe even a little bit positive, because the placements were weak, and that is the one thing that has continued to support the cattle market is we're just not putting the numbers on the feedlots. The weights have been light on marketings.
Because of weather?
Well, certainly weather related. And probably that's the major factor is the weather. It's not because the guys have had incentive, but after having a little bit of a struggle earlier in the year, I think people are quick to cash in the profits when they can. So it's we're not overfeeding, and of course that is one of the issues we're having over the hogs right now. Is just far too much pork on the market at this point.
A quick question for you. When you look at the cattle markets as a whole, we've been putting in higher highs, especially in the live cattle side of things, and higher lows. Does that attract spec money into the live cattle market?
Well, of course, that's the traditional definition of an uptrend. As long as you consistently put higher highs and higher lows in, you're in an up market. Yes, money tends to flow where they think it's going to show the best return. That said, they also there comes a point in time where they look at relative value as compared to competing products. In this case, it's you're going to look over the pork and say, geez, do I get more bang for my buck investing in the hog sector, or do I look at it in the cattle sector? And I think at this point in time, you're starting to shift that over to hogs. So it's.
Let's talk about hogs.
Sure.
They had a crazy week as well. Limit up a couple of days, limit down yesterday, I believe it was.
Yes.
African swine fever or something else causing that?
You know what? Again, I think we've had a number of situations where the hog market's been disappointed time and time again. One, I think everybody was maybe a little bit too geared up that, boy, this African swine fever is really going to create a big export demand. That really hasn't materialized, and probably understandably so. It's probably going to the last half of 19 if China really steps up and needs to start bringing pork into their country. So we were premature in thinking that. One, and two, if you go back to the reports, the last hog and pig report, we're looking at 1-2% hogs increases, but here we're seeing 4 and 5% increase in slaughter numbers, partially weight, but partially head. So I mean, it would appear that those numbers were understated. So it's you've disappointed the trade in several different ways, which I think has just exacerbated the problems to the downside. Hopefully we have a lot of that behind us. Certainly the African swine fever situation is not going away in China and could be spreading to some other countries at this point. So, that's something.
All right. Thank you, Dan.
All right, very good.
We'll continue that discussion in Market Plus. That wraps up the broadcast portion of Market to Market, but we will keep this conversation going where we'll answer more of your questions. You can find it on our website at markettomarket.org. Check out our YouTube channel. This week you can watch the extended interview. Thank you for watching. Have a great week. I'm Delaney Howell.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.